The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hey, welcome to 2023. This is Brian Akers and Jeff Akers with Winning in Retirement. We're certified financial planner practitioners from Akers Financial Group here in Maryland, right here in Lutherville and Barstow in Harford County. We work with clients all around Maryland, all around the Mid-Atlantic region, country, and a couple around the world. We do thank you for listening to our show, Winning in Retirement, and we got a show for you. The reason we have a show for you is that this show is called New Year, New Retirement Rules. And guess what? They reset the rules for many things during the Christmas break, just so that we can have more work to do, which is great. All right, Jeff, welcome to the show today.
Good morning, Brian.
All right, so I'm not going to say how this year's going. It's only been a couple of days, but you've worked all of them, which is great.
Oh, yeah, it's been hard.
That's good. You might need a day off. All right, so what we did is this. The show's called New Year, New Retirement Rules. As advisors, we are truly coaches for people that want to win in retirement. And over the last 2 weeks, Congress has put together new rules for the retirement game. This show is to explain how it helps you to reach your retirement dreams. But the coaches, the financial advisors, we study all these different rules and then help you implement what's best for you in your exact situation, one client at a time. This is a show you need to listen to and try to understand two basic things as we talk about all the different parts of the law. The idea is this: save more and make your money tax-free. That's the bottom line I want you to understand after all the talk is save more and make your money tax-free. All right, Jeff, sir, we'll get started on the show. You good?
Yeah, that sounds great, though. Make your money tax-free. I like that.
All right, so you got to keep repeating that as we go through to make sure everyone is understanding. You listen to the noise of all this stuff, and then what is it really trying to accomplish? We're trying to help you understand that retirement is your retirement. No one's going to care more about your retirement than you. Yep. So an advisor that coaches you to maximize it is the key ingredient to helping you get there. The idea of having new rules is something that can be exciting and also frustrating. But what's good is that there was basically a compromise in House Representatives. They're working on this all year long. We didn't know when something would happen.
Right.
Then they pushed it all into a 4,000 plus page bill.
Yeah, 4,100 pages, an omnibus bill. That's all we heard at the end of last year.
Yeah, Consolidated Appropriations Act of 2023.
2023?
Was that?
Yeah, okay.
Okay.
Yeah, even though they passed it in 2022.
Right. So, but they're also calling it Secure 2.0.
Right. That's a part of it that has to deal with the retirement section of it.
Okay. Secure was back at the end of 2019, right before the pandemic started. Mm-hmm. That changed a lot of things, and that made some major changes for beneficiaries, major changes when it came to really how you work your retirement accounts.
Right. There were a lot of different changes that happened then, and for beneficiaries as well as for making contributions to plans and stuff. So This is like the next step beyond that. We're
almost like the cleanup. Now, Secure Act, what happened was you have to understand what it was, why they called it Secure Act. It was called setting every community up for retirement enhancement. Setting every community up for retirement enhancement. Secure.
Yeah,
Act.
The government likes acronyms, so they come up with whatever words make the acronym they want.
Yeah, a couple weeks ago I had Ed Slott on the show, and what we talked about was when they name something, you need to run the other way, because whatever they're saying is usually the opposite of the goal.
Ooh.
Now, the idea of Secure 2.0, secure would mean more of a guaranteed retirement. And what I get out of all these bills is we need to save more money. We need to pour more money away. We need to do it ourselves. That's what all of these enhancements, all these changes that we're going to try to focus on actually do.
All right. So the idea behind the bill, I guess, is to allow us to secure our own retirement. The government's not doing it for us.
Yep.
The government's just giving us the ways to do it for ourselves.
Right. And so there are some cleanup issues. So financial nerds, financial geeks are really getting into some of the changes, which are, some of them are good, some are still confusing. There's already articles written on changes to the law to fix mistakes written in it. But that happens when you design a bill that big.
Right. I'd say that as we studied to prepare for this show, we probably spent more time reading through it than Congress did before they passed it.
Well, I know in the House they designed the compromise over years. So I'm
right.
hoping
The Secure Act, that part of it should be.
Yeah, if they spent more time. I agree with that. I don't cut them out.
Maybe not the whole 4,100 pages, but
well, not all. I didn't read all 4,100.
Oh no.
Yeah, we've been reading sections of it and trying to apply. So guess what? This show is not going to be reading the law to you.
No.
We're covering it all. We're going to say this: we want you to win in retirement, and that's the game we're trying to play. How to win in your retirement. Now we have some rules, and those rules allow us to do different things: save more and make more of your money tax free. Those are the bottom line pieces to get out of some of these law changes. Now, there's some other big ones we want to cover first before we get too deep into all the other pieces. Let's start out with Jeff with required minimum distributions. Can you explain the change that's occurring?
Okay, so real quickly, the RMD age, when you turned 72, you had to take money out of your traditional IRAs and your 401ks and whatever like that. When you turn 72, that has now changed this year, 2023, to age 73. Now, it's going to be age 73 for 10 years, and then it's going to be 75. So we're not going to worry about 75 right now. But for right now, if you're turning 72 this year and you thought you were going to have to take the required distribution, you don't.
All right, so the basic math is this. If you're born 1951 to 1959, you do not have to wait to take RMDs at 72. You do it at 73.
Right.
If you're born 1960 or later, you get to wait till you're 75 years old.
Yep.
That's the basics. The other thing is that no new people are going to start RMDs in 2023.
That's correct.
And it's a weird thing in that in 2022, it was 72. Now they're 73 in 23. So that's 1950. If you're born 1950, you missed out on this law because you had to take it out 72.
Yeah, well, they raised it from 70 and a half to 72 a couple of years ago with the first Secure Act. Yeah. And so there were some folks that were like, oh, I'm going to have to take it soon. And, oh, no, I can put it off. And then they're like, oh, I'm going to have to take it next year. Oh, no. And they get to put it off again.
Absolutely. And so the laws that are in this act and the change affect a little bit in 23, some more in 24, some in 25. There's one piece in 27, and was it 34?
2033 is when it goes to 75.
Yeah, 2033 it goes to 75. Yes. So don't try to memorize any of this. We're trying to build some type of spreadsheet chart so we can plug ages and numbers and understand what applies to what, and that'll come magically. But
this stuff is why we're here, so we can help you.
Yeah. So if you break it down, it goes like this: RMDs, required minimum distributions. Since 1986, we save for every retirement, but in 1986 they came out with a law that says that, hey, when you get a certain age, you got to start taking money out while you're alive. It cannot all pass on to the next generation. You got to start taking it out because you saved it for retirement. Use it for retirement and pay us some taxes, which they enjoy.
Yeah, not necessarily use it and pay taxes. Maybe it was pay taxes and then use whatever's left. But
all right, so the best news about a postponement of RMD to further, what does that give us as advisors for our clients?
So one of the things we like to do is make more money tax-free. Remember, save more, get tax-free. Well, we can do a Roth conversion instead of taking an RMD in 2023 for folks who are turning 72.
It extends the time we have to do that.
Yep.
Now, what's good is when you're trying to plan out all those retirement years and you're looking at income and cash flow, the more successful you are, you end up hitting other limits and other taxation pieces, or even having a penalty on your Medicare called IRMA, which all gets combined by taking too much money out. And that was hitting people when they hit 72. Now it's being pushed to 73. It gives you another year to try to fix some things.
Right. And we've got several clients that we've been working on, okay, let's convert what we can before you have to start taking money out so that we're lowering that required distribution when it comes. But we just got another 1 year reprieve for those folks.
Absolutely. So the concept is this: if you're retired and you are looking at RMDs, that is when you're required to take money out. That doesn't mean you can't take money out. It just means that at a certain age, they're going to do a calculation and tell you got to take money out.
Right.
That generally will mean more money has to come out that first year. So you got to plan that and then check out your tax plan to see where we're going to sit tax-wise.
Right. Be ready for it.
We still believe that 2023, 2024, 2025 are the best 3 years to pay taxes based on the future. So we need to make sure we take advantage of what is here, what we're talking about for those that are nearing those retirement years.
Right. Now, there's one other change with the RMDs, which has to do with the penalty. You want to tackle the penalty?
All right, so a penalty. Let's say you hit 72 and 22, but you just forgot about it. Now, thankfully, in the first year, you can wait to April still.
Right.
Yeah, I don't think they covered that rule yet, but you can wait to April. But you got to take it by April. If you missed, there was this penalty of 50% of what you had to take out was the penalty. But they had exceptions and a special form for exceptions, and basically everyone got approved for exceptions. Very few people paid it.
Right. If you missed it, you'd hurry up and take it the next year and then send the IRS a letter that said, "I'm sorry, please forgive me." And they'd say, "Okay, you're forgiven."
Right. So now they have sort of a little sliding scale, right? Are they dropping it to 25%?
Yeah, so the penalty's less.
And then to 10%.
10% if you correct it in a timely manner.
Okay. So 25 is after the timely manner.
Right. If they catch you, it's 25%. If you catch yourself, it's 10%.
Okay. That's the oopsie idea.
Right.
So the idea is if you have IRAs, retirement accounts, anything like that, you have to understand there is a required minimum withdrawal, and that's a big deal. The other thing they changed on required minimum withdrawals is you no longer have to take one out of a Roth 401k.
Right.
That's a big deal for people putting money away for Roth 401ks. If you kept your money in the Roth 401k before, you had to take an RMD out, even though no one else has to take money out of a Roth.
Right. Roth IRAs weren't subject to RMDs, but the 401k, the employer plans were.
All right. So what we learned so far in the first quarter is RMDs changed, bump the ages later. We can convert more. We have more tax planning and income planning we can do. You got to see an advisor to do that kind of work. Today's show is called New Year, New Retirement Year, New Retirement Rules. This is New Retirement Year too, but it's New Retirement Rules. Now, Acres Financial, we're local, we're independent, and we don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville and Forest Hill and clients all around the country, even some around the world. It's so easy to begin winning in retirement. You can call us for a free consultation with one of our team of advisors. Go ahead and call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Is now the time to save more for your retirement dream? The rules are changing. We will explain in the second quarter in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to the second quarter of Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group. I'm a certified financial planner practitioner. And I guess radio host, right?
Yeah.
And you're Jeff Akers.
I'm Jeff.
And you're a founder with me?
Yeah.
You were there?
I was there.
Absolutely.
See, I like to say Brian and I are cousins. That's why we got the same last name. So he's the owner. He's the founder. I'm his cousin. That makes me vice president.
Yeah, you had to do all the work.
I wasn't going to go there.
Yeah. Sorry. It's a wonderful thing to run a company with great employees because they truly help you reach the goals of your company. Now, one of the things at Acres Financial Group that means a lot to me is one client at a time. The wording means that when we sit down together, it's about you and your retirement, your goals, your situation. It's not about anything else. Now, they came up with new rules like fiduciary and best interest and all that kind of stuff. That's new, and to me, that's still not as good enough as, hey, it's your time, one client at a time. Right. And that's what we've been able to do all these years is work one client at a time.
Right. Work each situation, we call it a financial fingerprint.
Yeah.
So as these new rules, we're talking about what they are, but one rule might apply to you differently than it applies to your neighbor, your brother, whatever. So you need to know how it applies to you.
All right, so New Year, New Retirement Rules is the name of the show. As we get started here in 2023, we're here in the second quarter. The first quarter, we covered RMD and some basic concepts there. But we want you to understand throughout the show that the main point to remember, save more and make more of your money tax-free.
Tax-free.
Tax-free. So the tease coming into this, it's like a tease. It's sort of a... what's coming up next?
Yeah, we told you what we were going to talk about.
Yeah, and I said to Jeff, is now the time to save more for your retirement dream. the rules are changing. And the question to Jeff is it time to save more?
Yes, it is absolutely time to save more for a lot of reasons. But some of the reasons have to do with this particular bill. And this bill helps us to save some more.
Right. So let's understand that what we're going to be talking about now is for everyone working. You're in the workplace. You're still working. You're not retired. So this section is about saving for that retirement dream, saving money that can be put away for you. Putting money away for you is the key ingredient of having something in retirement.
Yep. You have to save it in order to have it later.
All right. So there's a basic thing called auto enrollment. What does that mean, Jeff?
So you start working for an employer, and after a certain amount of time, they automatically enroll you in their 401k, 403b, whatever kind of plan they have. And they might have an automatic schedule for how much you're going to contribute. It might start out at 1%, and then it goes to 2% of your salary and so forth until you work your way up to a certain level, and then they'll stop increasing it after you reach that level. So the idea of an auto enrollment has been really good, but it wasn't mandatory. And starting in 2025, any new plan that's created after that.
Any brand new plan.
A brand new plan.
That means if your company does not have one, you're working somewhere for someone. Go ahead.
Right. So you're working somewhere for someone in 2025 and they say, hey, we're going to start a 401k. We never had one before. We're going to start one. Well, that plan will have to have an automatic enrollment provision in it.
Sure.
So it's going to start a couple of years from now. If you're working for someone now and there's already a 401k and you're not participating, it's not going to automatically enroll you. You need to take the steps in order to start saving more now.
All right. So if someone's setting up their account right now, what kind of percentage, no matter what age, would you say they've got to try to hit?
Right. So you want to know one thing is how much is the employer going to contribute. You've got to, at a minimum, make sure you're maximizing whatever that match is. But kind of as a rule of thumb, get to 10%. If you're saving 10%, you're maximizing whatever the match is.
Right.
That's kind of a given. And you're putting yourself on a better trajectory for a good retirement down the road.
Absolutely. Now, one of the rules that's coming into effect is the fact that if your employer matches, once a company has the opportunity to update their plan document and then implement it through custodians and get all this logistics done, there's going to be a time. I didn't really see a starting date in the summaries and things we've read so far, but
I didn't either.
The idea is that the employer match has always been pre-taxed. Pre-tax means the employer puts some money in there, and it's like a gift to you. It's in your account, and then you pay tax when you take the money out.
Right.
They are going to have an option that you, as the employee, will be able to elect. Okay. And the hard part is going to be this. If you get handed this paper from your employer, you should call your financial advisor. And the reason is you need to understand the impact of saying yes to Rothify your match.
Rothification. That's a big word in this law.
We're going to explain a lot in the third quarter about why tax-free is so wonderful. But the concept of this workplace change is that employer contribution will then go into your taxable income, and you're paying tax on what they put in.
On it now.
So that means I'd have to figure out the exact math on tax brackets, but generally, if they match on 3%, they take 3% of your pay, then roughly 1% of that, or say 20 to 30% of that money they match with. So if they give you a $3,000 match, it might be $600 is your taxes on that.
Right. So you're going to have to pay taxes now if you use that Roth option for the employer contribution.
I believe it's a way of savings when we're paying our tax now. What we're doing is we're taking a future expense that's larger, because if we accept an employer match pre-tax, what happens is that money comes into our account and we pay tax later. Now that might be good for you. It's really, and I'll explain why that makes sense in a few minutes. But right now, you get that money, it goes in there, and if you elect to Rothify it, make it Roth where it's tax-free later, you pay tax now on that portion. The money's still in the account, and it grows tax-free.
Right, and you've talked about the idea of saving and Rothifying between now and 2025 because of current tax law that was passed several years ago, and taxes are going to go up in 2026. So if you Rothify this employer contribution, then you're paying now at lower tax rates than you would down the road when you take the money out.
What to remember about what we just said is this. Your employer, when they're ready and have everything in place, will offer you the employer match to be Rothified. Roth means that you'd have to pay tax on the employer side, which will mean you'll bring home less money if you elect to do that.
Right.
Depending on age, and in most cases, we like the idea.
Right.
Now, what are some reasons we would not like the idea?
So it could be that you're a pretty high income earner and you really like giving to charities. Mm-hmm. And there are certain rules, we'll get to them maybe a little bit later on, but there are certain rules that allow you to make that required distribution we talked about in the first segment. You can send that directly to a charity and not pay tax on it anyway.
Right. So if you're charitably inclined and you have a larger and larger portfolio inside your retirement accounts, and prior to this law, you have a lot of pre-tax already, you might do the Roth, but if you want to build the pre-tax more so you can give more to the charity later in life, that's an option.
Right. Now, if you're younger, I'd think that putting it on Rothifying your employer plan and then having all that tax-free money in retirement, that just seems like a great idea, but we'd still need to look at the specific situation.
Yeah, absolutely. And about the concept here in the second quarter about saving more, one of the things is something called a catch-up and even contribution levels. So contribution levels for 2023, they are $22,500.
For 401ks, yeah.
Yeah, 401k, like TSP, 403b, all come in that same category. And then that's for someone under 50 years old, and over 50, there's something called a catch-up provision.
$6,500 this year.
75.
Is it 75 this year?
I'll take 75. Yes, it's 75. We go to 30,000. Yes. Yeah. Now you owe me a Wawa.
Got me.
Catching Jeff is difficult, but man, it's fun when you get to catch Jeff on a small air. But the cool thing is this: we can put $30,000 away if you're over 50 years old. I use the word we because guess what? Over 50. But there's an advantage. You get to catch up. Some of the new rules that they added in there is that they have, if you make more than $145,000 in a future year, they're going to make that be Roth. You can't deduct it.
Yeah. There's a lot of gray area in this piece of it because, what if your plan doesn't offer the Roth option?
Yeah.
Then it looks like right now, then nobody's allowed to make a catch-up contribution after 2025. So they're going to have to fix that.
Yeah, we're not going to be negative about the bill. We're taking the good things. But the idea is you can save more. So imagine that you're doing extremely well and you're successful saving money. The problem is that you want to save more. Well, guess what? If you're doing $27,000 in 22, you can do $30,000. Go in there and change that contribution level to hit that number this year. Yep. That's so you can do that. The other thing that we do this a lot is when the kids move out, they actually do move out, and there's more money. You can save more money and have your race to retirement years, and that's where you max out everywhere you can. Some people don't enjoy this, especially if, let's say we had a husband and wife and one of them makes less, but we still want them to put $30,000 of their salary away. So if they made 60, they might put half of it away, 50%. You're allowed to do things like that. Yep. That's a way to save more.
Yeah, and you talk about that race to retirement. Congress actually defined when that happens. It's between the ages of 60 and 63. And it's going to take effect in a couple of years. But at that point, your catch-up contribution is going to be more than whatever the normal catch-up contribution is.
Yeah, so we'll have a chart. And if you have a financial advisor, they're going to coach you to make sure you're maximizing, hitting your marks everywhere you possibly can.
Right.
The HR at your companies and their process, the custodians are going to have to fix all the software to address this. I'm not sure how long it's going to take.
The match is also going to be indexed to inflation, so it's not necessarily going to be the easy numbers that we have now.
But the idea is this. It's called New Year, New Retirement Rules. They're helping us to save more, and we would love for you to consider to have more tax-free. So if you're given a piece of paper about a Rothification of your employer match, that's one option to choose. Can you save more to catch up once you hit the age 50? Yes. Simple and SEP IRAs, there's Roth IRA contributions where you can put money to Roth instead of only pre-tax like before. These are just things that I'm just trying to throw out quickly that are letting us...
Yeah, there's a lot of really good changes.
But the buzzer's sounding. The second quarter is coming to an end. New Year, New Retirement Rules is the name of the show we have today. At Acres Financial Group, we want you to win in retirement. Because in retirement, the biggest worry of your day should be where to drink your morning cup of coffee. Where every day seems like a Saturday, free of stress. Your retirement income or investments are all taken care of by the team of advisors at Acres Financial Group. If this is the future you want, it's not too late. It's so easy to begin winning in retirement. Meet with one of our team of advisors, a free meeting with you, and we're going to talk about your retirement and your retirement goals and how to plan your retirement game. You can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or give us a call at 833-946-7384 to start planning for your retirement now. Don't miss out on the Roth. Uncle Sam, a.k.a. the IRS, will love you in retirement if you do miss it. We will explain why this is so important in just 2 minutes when Winning in Retirement continues.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hello, I'm Brian Akers. Today I have certified financial planner practitioner Jeff Akers with me. He's been in the financial services industry for over 23 years now.
Ooh, yeah.
He knows his stuff and is highly qualified, and that's a pretty good thing. Thanks for being here, Jeff.
That might sound like a long time, but Brian's been at this about 10 years longer than me. Maybe even a little more than 10 years.
Like the years go by fast. We try not to mention anything over 35.
Well, more than 35 years then.
Okay. All right. So the show you're listening to is Winning in Retirement by Akers Financial Group. We have offices in Lutherville and Farstow. We're available and we're licensed in many, many states, so we can talk with clients really all around the country, around the world.
Yep.
The idea is this. We want to set a show that's going to start off 2023 with the things that we need to do. You know, the things that you got to do for yourself. You need to think about how to save more and how to make more of your money tax-free. And that's what this show is about when we talk about the new year and the new retirement rules. Over the next few years, we're going to be giving opportunities to save more in certain ways and to Rothify, make things tax-free in the future by paying tax today. Many options, many opportunities depending on where you work. So we put together this question for the third quarter, and that is this, Jeff. Let me see if I can read it properly. It was a tough one. Don't miss out on the Roth. Uncle Sam, a.k.a. the IRS, will love you in retirement if you do miss out. So what do we mean by all that?
Well, we've talked a little bit about it up till now, but right now tax rates are low. Later on, they're going to go up in 2026, and by the time you retire and start taking money out of these plans, they're likely to be higher. So if you save money now and pay the tax now, and then don't have to pay tax again, that's the Roth.
Can I argue about the likely thing?
Okay.
So you're saying in 2026, the word likely go up?
2026 likely doesn't apply. That's in the law now.
That's going to be a jump. It's going to jump.
Taxes will go up in 2026.
And then the likely be added on top of that jump, right?
That's correct.
Okay, that's where the likely applies.
Yeah, that's where likely applies.
I'd like to clarify things for you guys because you're driving your car. I'm not sure what speed you're going at, but you're listening to the radio show and it's like, all right, that sounds interesting to me. Does it apply to me? And what motivates me to do something now? This is what should motivate you. Tax rates are low now. Rothifying, paying tax today is the best long-term thing in most cases, depending on if you are allowed to based on laws. But the idea is understanding we pay tax at a lower rate. That means in the future, when rates go up, they're going to go up in 26 and then likely more. That we're going to be avoiding that by paying tax today and never again.
Right. So we're paying tax today, and any investment we put in there, we want it to grow over time. So if you've got 20 years or so before you're going to need to take it out, that has a chance to double a couple of times in value. Now you're paying a higher tax rate on a higher balance of money.
Yep.
So it's kind of a double whammy at that point. And that's why the IRS will love you when they make you start taking money out of those plans.
Absolutely, because we have people that come in and they're already saved their whole lifetime and they're ready to retire in the next month or so. And so we can't go backwards and Rothify, make things go into Roth, but we can do it to the future through Roth conversions. But the thing is that if they're retirement pre-tax poor, meaning they put everything pre-tax, that's the only thing they ever saved in their life, that's their only source of funds in retirement, and it's always taxable on every withdrawal.
Yeah, and things come up. We get to retirement and, who knows, you might need a car. And you think, well, I got all this money. I'm not going to take a loan. I'm just going to pay cash for it. Well, now you got to pay cash for the car and tax on the money that you use to pay cash for the car. So that $30,000 car is now a $50,000 car.
Absolutely. So the idea is this, the word Rothification. Can you explain that one to me, Jeff?
Well, Rothification is just the idea of moving more money into the tax-free area. And this law, the new Secure 2.0, gives us a few more ways to move money into that tax-free bucket.
And that is things such as the employer match. Once your company is up and running with the right ability for you to make that election, that might be something to consider where you pay a tax now and never again, even on the matching part.
Right. So the employer match is one. Another one is you might work for a small company and you have a simple IRA, and Roth was never an option in the simple IRA. Mm-hmm. Well, now it's going to be an option.
Right.
It's effective this year, but that doesn't mean that the company that's sponsoring the Roth IRA has all the paperwork ready to make it work. So it'll be later this year.
Yeah, they just made the new law up and passed it, and now they got to take it and write
January
it
1st, you can do it.
Yeah.
Yeah.
All right. So the other little thing I want you to understand is this. Let's say you're new in your career, your income's not too high, but you're starting to save money into your IRA, Roth, or 401k. There was something called a saver's credit. And in the future here, there's something called a saver's match. So if you, on your tax return, show your Roth contribution, your IRA contribution, 401k contribution, and if you're at a low income, you get an actual tax credit on your return.
Right. So it's a way to, get a refund.
Yeah.
But the change, I believe, and you might have to correct me on this one too.
No, I already got my one for a lifetime.
But the change that's coming is instead of sending you that credit, they'll actually put that credit into your retirement account.
Yeah.
So it's more savings for retirement.
Yeah, I'm not sure how I feel about that one because I like the idea the credit is in that person's pocket. The tax credit is $1 for $1 off what you owe tax wise. Instead, you're still going to owe, and then they're going to take the credit and put it in your account.
You're still going to owe, and congratulations, you saved more for your retirement.
That means you got to tell them all about the account you want to put it into, with all the account numbers and other information on the return, right?
So there is the privacy part of it. Yeah, that comes into play too. But the Secure Act, the idea behind Secure is we're going to make your retirement secure or help you make it secure. And this is a way that they're kind of forcing this is going to retirement.
And there's another piece in the law, which right now we're not sure if it's going to help people much at all, but there's something in there called a 529 where you can roll a small or a portion over to a Roth IRA.
Right. And this whole section is gray area now. What are the rules going to be? So I wouldn't make your plans right now on how to do it. There's going to be some corrections and guidance and all kinds of stuff coming out this year and probably next year and maybe the year after that.
Yeah, so the bottom line thing on a 529 plan, one thing is this. When your child is born, open a 529 plan to start a 15-year clock. Right. Under this tax law, there's a 15-year clock. If you have money in a 529 or the account was open for 15 years, that's one of the gray areas is what money counts. Right. Money in the last 5 years doesn't count. The money in the previous.
Right. So you'd want to make a big contribution, as big a contribution as you can when they're born, and then 15 years later, all the money in that plan, because you never contributed again, would be eligible for this because it's been there for 15 years.
But up to a limit of only $35,000, and you can only transfer Roth contribution like $6,000 a year or something like that.
$6,500 would be the number for this year, but
and that would be the number that you could convert of your 529 every year. So it's
into the Roth.
A bit of a paperwork nightmare in the future. But the key thing on 529, if it's been around 15 years, it's an option.
Right. But another one of the gray areas, though, is what if you change the beneficiary on a 529? That's one of the great things about a 529. This one's not going to use it, but this one is, so I'm going to change it to them. Well, you could change the beneficiary. Does the 15-year clock start again?
Or do you get a whole nother 35?
Or do you get a whole nother 35? Yeah.
Which I like the idea where the whole family can opt this 529 around the whole family and put 35 to Roth for each one, especially if you overfunded the college planning and the kid went another direction. Yeah. I don't know if that's possible yet. We're going to find that out. Yeah. So we're going to stick with what the reality is on the laws. The idea is this. If we can save more, that makes it better. If we can Rothify, that's where you pay tax today and never again. That is a good thing facing the tax laws that we know of right now.
Right. So keep in mind, the whole show, it's about save more and make more tax-free.
Right. And so Roth contributions are where if you make under a certain level of income, you can put money into a Roth IRA. That money in a Roth IRA can be done as a contributions. now this new law is opening up the idea through your 401k where you do a Roth. And then what happens is the match could be possibly Roth at your plan sometime or coming soon. Maybe a better way of saying it.
So it expands the Rothification of 401ks. It creates the Rothification of like simple IRAs and SEP IRAs, things that didn't have it before.
Yeah. The idea of saving for retirement is harder when you're a small business owner. And so our small business owner clients, we have to sit down with their situation. If it's a one-person company, like a consultant or whatever they're doing, one person, there's certain kind of retirement plans that fit really well. And then as people grow their companies, then things like SEP IRAs, and then we switch into simple IRAs fit, and then ultimately into 401ks. There's also something called a solo 401k for one-person companies. And these options, some of them you can always set up after you got your taxes done. You can sort of figure out what was right. Solo 401k was not one. With the new law after 2023 and beginning of 2024, you can actually set up a solo 401k after the year end, which I think is a very big improvement in the design of small business planning. Small business retirement planning is where, as a business owner, you say, well, how can I save money to my future tax and get that tax write-off, or not get a tax write-off and make that money be tax-free. And understanding all the options is very important. You sit down with an advisor and we work through what's best. That's what's best for small business owners, is to manage every hard-earned dollar.
Right. A lot of times small business owners, they start out and all their money's just getting plowed into the business. But eventually you want that business to be sustainable and create income for you that you can set aside. And so Brian's talking about what are some ways I can set it aside and get the same advantages that my employees could get.
Yeah, so we're not trying to cover every piece in here. There's a lot of small things, a lot of fixing, a lot of changing. We're trying to cover some highlights that we think affects general planning when we're thinking about you guys that are listening. Now, when you're listening, you're thinking about, well, do I save any money in retirement? Well, if you're not, please do. Start right away. You need to do a Roth IRA if you don't have one at work. Once your work has an auto-enrolled, don't be upset about it, and do not opt out of it.
No.
Let that happen.
Yeah, it amazes me how many people I sit down with, and they're like, yeah, I've got one eligible, but I'm not contributing to it. Do they match? Yeah, they give a match. It's like, you're giving up free money.
What normally happens, people do the paperwork on the first day they go to a company, and they never look at it again. Mm-hmm. When they finally meet with an advisor, then we try to fix things and change the beneficiary. We change their allocations. We look at their contributions. We show them their website that they haven't logged in before. Teach them where they can change their contributions. They could split, some pre-tax, some Roth, all kinds of stuff. This all applies to financial planning, and that's really what we want to spend our time on when we're talking about making sure that you are truly prepared for your retirement years. Because the best part of retirement is going to be about getting your time back. You get to decide how to use it. Before retirement, your time is tied up with other commitments, like mainly your job. A lot of that goes away in your retirement years. Your time is now consumed by things you want to do. That's the retirement dream. It's so easy to begin winning in retirement. Just go to our website, acresfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's acresfinancialgroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Your financial coach should know the new rules so that you can win the retirement game. That's exactly what we'll be talking about in 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome to the fourth quarter of Winning in Retirement. I'm Brian Akers, and here with me is Jeff Akers. We're both certified financial planner practitioners at Akers Financial Group, located right here in Maryland. But we work with people all around the country, and we look forward to working with you. We are both CFPs, and that means that as financial advisors, we're here to advise you on your retirement. It is us giving you the best advice that we can so that you'll have the best retirement that you can. The show today has been New Year, New Retirement Rules. So welcome to 2023. The game of getting ready for retirement has a new set of rules. And that's not a bad thing. It gives us more options, more opportunities, I think. and that we have to take advantage of over the next few years as the rules sort of phase in. Understanding how it applies to you is what this fourth quarter is all about. So if, in case you miss anything from our show, you go to our website, AkersFinancialGroup.com. Akers is AKERS, financialgroup.com. You go to that website, click under radio. You can hear this show through the website, or you can hear it through some podcast sites out there. So the show is called New Year, New Retirement Rules. And this segment, we're talking about your financial coach should know the new rules so that you can help you win the retirement game. It's the hardest thing is that there's a lot of new rules, but applying it to that person is really what we're trying to talk about today.
Right. One of the neat things about this job is we're always learning something new.
Yeah.
And so every year Congress is going to pass something. Something's going to change somewhere in the world. And so we work to learn it.
And with those changes, you then have to understand how to then apply it to each case. Right. So imagine you're working on your retirement. You get to do it one time and you want to do it right. You want to make it last a lifetime. It seems like a risk to do it alone. To me, it seems like if I'm going to do a retirement, I need someone who's helped somebody else retire.
Right.
Or how about help hundreds and thousands of people retire?
Right. Someone who knows they've done it before.
They've been there and they know how to guide you to make the best decisions. Now, you can spend a lot of your time trying to research the best decisions and still not get it right.
Right.
We've had even the most educated people come in and talk to us, and we've tried to help them, found ways to help them do even better with what they're doing.
Yeah, but even as you talk about new retirement rules, sometimes people come in and they start talking about what they're going to do, and it's based on old rules.
Absolutely.
And so we have to educate on what the rules are now.
Yeah, these rules are sort of things to play the game in. We still got to play the whole game. The whole game is diversifying, lowering risk as you get ready to retire, being ready for a volatile stock market year so that you're not giving up all the retirement you saved in the final couple of years before you retire. The hard part about these retirement plans we talk about through our employers is they have very little protected pieces. So we need to balance the portfolio and look at reallocations, and that's really where we spend a lot of time on managing money and balancing the right answer out to implement properly for people. The financial coach needs to come alongside and help you maximize everything that you can maximize.
Right. So there are the basics, like Brian was just talking about, that haven't changed. But in this new law, there are some things that changed with, well, where's the best place to invest this money? And so, we love the idea of tax-free future income. So that's the Roth side of things.
Right.
And we love the idea of getting free money. That's making sure that you contribute to an employer plan. So get the match for that employer plan. Those are some basic things, but in this law, there are some changes to how that works and decisions that you have to make.
Absolutely. So what we've been trying to explain throughout this show is that the new rules that came through this budget act at the end of the year, they slid in a lot of things that was designed in committee that was a compromise Republicans and Democrats put together, and they put a pretty thoughtful way of fixing a lot of things. Mm-hmm. But then there's some areas that are not as crystal clear as they need to be that are still going to be corrected again later this year, I'm hoping.
Not quite as thoughtful.
Well, the math of the RMD 73, 75, when it kicks in, it's a little confusing. There's a couple other pieces that once you read what was typed out,
right,
that doesn't come across right.
Yeah. On one page it says one thing, and on another page it says something totally contradictory. So they'll get that fixed in the next few years.
Well, hopefully sooner than that. But the idea is this. There is a new rules, and generally what it does is it allows us to save more of our money through Roth. That's one of the biggest pieces. Right. That means if we're at a company that matches our retirement sometime in the next year or two, depending on the company and the custodian and all the paperwork they have to do, you might be given the option of deferring your employer match into a Roth rather than having it deferred tax-free. If you say go Roth, it's not truly deferring anymore. It means you got to pay the tax on that match in the current year rather than the future.
Right, you're paying the tax now, but then that money is never taxed again.
So a financial coach would come in, you get that paperwork, you call the financial coach, the financial advisor, and then we'd go over your situation and we'd say, yeah, if you go ahead and do that, send us your pay stub. We'll tell you it's going to lower your bring home pay by a certain amount based on the tax withholding.
Right. Now, a lot of these rules, and we've talked about save more, put more aside, be ready for retirement. And also in this law, they recognize that things happen. Things come up and people need to access their money. And before 59.5 in general, there's a penalty, a 10% penalty to take money out. And so one of the things in this law they did was say, well, there's always been some exceptions. Here's a few more exceptions.
Yeah.
And so they're creating some additional exceptions to that penalty to cover emergencies. Now, mind you, from our perspective, what we've been talking about all day is save more. Don't take money out of your retirement plan before retirement. It's there for retirement.
Right. In fundamental financial planning, you want to pay off your debts, build an emergency fund, and maximize your retirement plan the best you can. But you don't go above maximizing the match until you have an emergency fund.
Right.
But if there's no money, you have to find a way. If people take money out of the retirement plans in 2022 and they're less than 59.5, usually you paid up taxes and another 10% tax on top.
Right, a penalty on top of it.
So what are some ways that they're allowing people to take money out for certain emergencies in life?
Oh, gosh, there's a whole list. I'm going to bring up my page here.
All right, so you got a rough paper. Oh, yeah. Looking at the news. So one idea is that there's like a medical, if you have a medical deduction, there's a certain amount that you can take out of an IRA to cover the medical.
Terminal illness.
Yeah, terminal illness, disability.
Victims of domestic abuse.
Yeah, victims of domestic abuse, that there's a lot of exceptions to that, and understanding when that does apply, up to $10,000
right.
Can be used to help get through situations like finding a place to live, things like that.
And certain qualified long-term care distributions.
Yeah, and that's for your premium. So if someone's basically paying for long-term care, they could take it out of their retirement account.
And not pay a penalty on that.
Yeah, I don't think that's a good idea. But
right.
I think it has to be in your budget. If you're putting money in retirement and then pulling it out to buy your long-term care, you're not going to have the retirement money. I guess I can't think of a reason that makes a lot of sense unless that's the only source of money to pay the bill that year.
Right. So, mind you, a lot of these things, Congress put it in here. That doesn't necessarily mean that we agree with using it.
Yeah, there's a qualified disaster recovery distribution where you can pull money out. You can pull out only up to $22,000 to help you with that
situation. So your disaster better be less than $22,000.
And you got to do it within the first 180 days after the disaster occurred. And then you could pay it back within 3 years. So there's a little bit of that hybrid rule.
Right. So talk about getting into gray areas and complicated things. That's it.
But imagine this. You're going to have to talk to your accountant. I know, this is going to be crazy. The accountants are these bookworms that are typing and putting money down. They're going to ask you a question. And that question is, why'd you take the money out? And they're not just being nosy. They want to know one of these key words to take the exception so you don't pay an extra tax.
They're trying to save you money.
So don't ignore it. Imagine that when they send you that packet in January about filling out stuff and you took money out for 22, it doesn't matter. But in 23 in the future, what you're going to need to do is write down why. And so you can prove the why so you can not pay an extra penalty. It's worth the time to answer the accountant's questions.
Yeah, even for 22, tell them why, but it'll matter more for more situations in 23 going forward.
They're not just being nosy. They're not just trying to say, oh, we shouldn't be doing that and waving their finger at you. They are trying to find more deductions for you.
Yep. Yeah. I actually had someone one time say they went to their accountant. They had taken money out of a retirement plan to pay for education. And then there was something else going on that was an exception. She was like, well, okay, I know what you're saying, but just forget about all that. You took this money to do this, and that way we avoid the penalty. Yeah. And this other money didn't have a penalty in the first place. So,
all right. In the law, there's another weird thing. It's called the new emergency withdrawal exception. Now, emergency withdrawals. So imagine you're in your retirement account. You're going to be able to set up to a whole $1,000 into a separate money market or zero risk account that's going to sit there until you need up to $1,000 for an emergency.
Yeah.
And
$1,000.
That's a lot of work to get $1,000 to sit there to avoid a 10% penalty.
$100 penalty.
$100 at the most, right? Yeah. Emergencies happen. You need the money. Sometimes there's a cost to it. Generally, if you're in an emergency, it might not be at the high tax bracket anyway. But generally, the emergency withdrawal exception is some new thing they're going to have inside your retirement accounts where you can set $1,000 aside into a money market that sits there. You can pull out if you have to. You can pay the money back into it if you use it. And once you take a withdrawal, you have to wait 3 years to take another huge withdrawal.
Keep in mind, we want you to have an emergency fund beyond $1,000 to start with so that this never becomes an issue.
Imagine your plan needs a a network of answers, not just retirement accounts doing everything for you. It's not designed to be there for you. It's designed for your retirement.
Exactly. It's a retirement account. Use it for retirement.
So when we talk about planning in our other shows, we talk about fundamentals of planning. Make sure you're properly insured. Protect your family. Build your emergency fund 3 to 6 months, depending on what kind of job you have. Pay off your personal credit card debt, and then build the rest of the plan. College savings, retirement planning, reducing your mortgage and long-term debt, and building the dreams that you have in your future. Those 7 things help you truly get prepared for all that you can face, and so we don't even use some of these exceptions. All right, nowhere near touched every new change in these laws. We covered a few. Understanding there's ways to save more money. If you can bump your retirement contributions, do it right now. Go online, log in, and whatever it is, bump it 1 or 2% higher.
Yep.
If it's not 10% on your side as an employee, see if you can.
Bump it up there.
If you make a change there and then that paycheck it comes to your bank account and you're squealing, oh, that's too much. You can go back and change it.
Right.
In most cases. Some employers don't change it.
Know the rules.
Usually they'll let you lower it. They won't let you increase it right back again.
Yeah.
But the idea is this. You got to build your plan to make it work. Thanks for a really good show today, Jeff. I know it's going very quick for both of us. New year to 2023, new retirement rules. Sorry.
That's easy for you to say.
It is not easy. New year, new retirement rules. Got to slowly bring it out. We want you to win in retirement. That's the whole key thing about our radio show. Take advantage of this opportunity to begin planning with us at Acres Financial Group. To schedule a free meeting with one of our team of advisors, go to our website at acresfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com. Or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Acres Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Acres Financial Group. Acres Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Acres Financial Group and Archedios do not share any common ownership. Neither Archedios nor Acres Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.